Hi, and welcome to the third quarter market update for 2019. My name is Doug Johnson. I'm the senior investment strategist here at HCM, and we just wanted to take some time today to give a brief update and overview of our thoughts going into the third quarter and a little bit on our portfolio positioning. So as we take a look at where we are right now in terms of positioning, on the equity side, we remain at a neutral target. Just as a recap, we had slightly reduced risk back in the end of 2018 and then moved those position targets back to neutral here towards the beginning of the second quarter, and we remain at that neutral target right now. Really what we're looking at on an equity basis is that the belief that the global central banks are going to continue to guide towards more accommodative policy, and this is going to be supportive of risk assets, not only moving higher, but at least staying where they are right now. So that involves not only the reduction of interest rates, but also adding liquidity to the system by any type of quantitative easing programs, purchases of bonds to artificially keep rates low. On the earnings side, growth remains somewhat subdued after 6 quarters of double-digit earnings growth heading into the end of 2018. We've now had 2 quarters of negative growth, with the outlook for the third quarter hovering right around 0. So earnings growth isn't outstanding, but we think that's been kind of put on the back burner a little bit based on the fact that we think prices will be supported by a combination of not only lower rates now, but the expectation of rate cuts going forward. As earnings have kind of stalled while prices have moved a little bit higher, that's caused valuations to start to move back up, and they certainly remain elevated based on historical computations, but certainly off the highs that we've seen in early 2018. The portfolios also remain overweight U.S. assets, as we believe that the global growth forecasts will trail the U.S. a little bit. We don't necessarily think that there's going to be outstanding growth anywhere, but you also have the additional headwind that's been presented by the ongoing tariff issue, and up until recently, a fairly strong dollar. On the fixed income side, duration in the portfolio remains slightly below the index levels, but short duration bonds still are providing us with a compelling income story. Just as a quick reminder, duration is a concept that's used to describe the relationship between interest rates and price movements in bonds. So as a very simple example, a bond portfolio with a duration of 5, if you have interest rates move up 1%, bond prices will move down 5%. So as we've seen rates drop, we've been more comfortable removing some of our shorter duration bias, but we still do own some short duration positions in the portfolio for a source of income. We've seen the yield curve invert a little bit, and they're certainly signaling a dislocation, so to speak, of expectations between what the market predicts and what the Fed may do. Along with that, inverted yield curve has historically increased the probability of recession, so we're certainly continuing to keep an eye out on that. But everything that we're seeing right now economically isn't pointing towards a recession being imminent. On the high yield bond side, we feel that high yield bonds still remain expensive and don't offer a whole lot of value. Economically, as mentioned earlier, global growth forecasts continue to be hampered mainly by uncertainty surrounding the tariff issue, but outside of the tariff issue themselves, just kind of maybe of a topping of the growth cycle, so to speak. So we're not seeing growth anywhere that would be strong enough to signal inflation and possibly weak enough to continue to have central banks be supportive with monetary policy. The U.S. China trade negotiations broke down, so to speak, the beginning of May. We've seen kind of an escalation of rhetoric, so to speak, in the weeks following. But over the past, I'd say 2 weeks, it's kind of died down a little bit. And we think that story has been put on the back burner a little bit as the Fed continues to work through their rate policy decision. Inflation expectations continue to move lower, and we're currently right below the Fed target of 2%. So we're not quite concerned about inflation yet. We just had a decent CPI print come across today, but one month is not enough to believe that there's a trend going forward. So the risk going forward, we could see third quarter earnings come in weaker than expected. The expectations are pretty low already, but anything below that could have investors starting to be concerned about growth. If belief wanes in the ability for global central banks to support risk assets, that could also cause some increased volatility. You've got the U.S.-China trade rhetoric. If that continues to deteriorate, that would more than likely cause some issues. And then finally, with the yield curve inversion that we talked about earlier, we need to keep our eye out for possible recessionary signs going forward. So that's a brief overview of what our thoughts are for the third quarter. If you have any questions, comments, concerns that you want answered, please don't hesitate to follow up with myself or your advisor. We'd be more than happy to walk through those issues in greater detail. Thank you for joining us, and we hope you have a good day.